Welcome to this week's video, where I discuss what I believe is important for individual investors to understand and consider before they make their investment decisions over the next 1 to 2 weeks. This week, we're going to talk about how the markets seem to be held hostage to the 10-year government bond rate out of the US. We're going to talk about why corporate earnings don't really seem to matter much. Their corporate earnings seem to be very good, yet the share prices of these stocks don't seem to go higher. And lastly, if share prices aren't moving higher on good earnings, and if we believe interest rates will continue to rise, why should anybody be investing at this time in the markets? Stay tuned. The 10-year bond rate in the United States has now pushed well past the 3% mark, somewhere around 310, 315. It actually did that in one day. We saw interest rates in and around 290 to 3% for quite some time, and the market was able to digest this. However, when that rate, the 10-year bond rate, went through 3%, that caused the market to sell off quite significantly, and it just seems like the stock market, the North American stock markets, are being held hostage to higher 10-year government bond rates. The problem, I guess, for investors is we believe the 10-year bond rate will continue to rise. And if so, will the stock market be able to handle it? In my opinion, I think it will, because I believe at some point the 10-year bond rate will not rise any further. I think we could see another 6 to 8 weeks of possible interest rate increases, but hopefully as we move into the second half of 2022, the bond yields, or overall the 10-year bond rate, will start to slow down and even off. And when that happens, I think the stock market can actually rally with a more stable 10-year government bond rate to come. If someone were to ask me how the corporate earnings season has gone over the last 6 weeks or so, I would have answered, I think it's actually going pretty darn well. We've seen in the United States 75 to 80% of companies beating what was expected of them by analysts today, beating expectations on the top line revenue growth and even on the bottom line. When these companies do report good earnings, we see the stocks or the share prices of these companies rise, maybe 4, 5, 6%. However, because the stock market is taking its cue from the bond market and continues to do so, if the bond market or interest rates were to rise, we quickly see these share prices fall once again. Therefore, I'm looking at this from the standpoint of the micro or the individual earnings of these corporations don't really seem to matter much at this point in time. The stock market is taking its cue from the macro or the overall interest rate picture. Going forward, however, I continue to see strong earnings results from a number of companies: tech, retail, banking, pharmaceutical. There are some really good earnings in all these industries and all these sectors. So going forward, continue to look for companies that have reported good earnings and continue to talk about a positive story going forward. I think it's only a matter of time before we see the share prices of these companies move significantly higher in the second half of this year. So with share prices not rising based on their corporate earnings results, and the anticipation of higher interest rates to come perhaps over the next 2 to 4 months, why would any investor put money to work today? Why shouldn't they wait until perhaps September or October before they put more money to work? The answer, in my opinion, is you can never time these markets. And I think right now there are some really good investment ideas out there that are trading pretty much for a 30% discount, maybe even as much as 40% on sale. I don't know how quickly the share prices of these companies will rise in the second half of the year, and obviously there are no guarantees that they will rise at all. But in my opinion, when you're an investor and you're looking to put some money to work for your future, not for tomorrow or maybe even next month or the next few months, but when you're investing for the future, longer term, these are the opportunities. These are the times where you could put money to work, not for tomorrow, but for maybe a year from now, 3 years from now. I know everybody seems to say we're long-term investors, and in talking to many investors, I know that might be maybe 2, 3, 4 months. Long-term investing is very difficult, especially if the market is going down, but we need to stay with it. We need to have that iron stomach to buy when things are going down. You don't want to buy at the top. You want to buy when things are cheap and at the bottom, and hopefully ride the wave higher. And right now, taking a contrarian approach, buying good quality names that have seen their share prices fall significantly, in my opinion, is the best recipe for success for the next 1 to 2 years. Maybe not for tomorrow or next month, but for the next 12 to 24 months. And that is how investors can buy during these difficult times.